Hey everyone, and welcome to today's Explainer. I'm host one, and alongside me is my co-host, host two. We're financial advisors, and today we're tackling a massive fundamental economic concept, the income method.
That's right. As advisors, we spend all day looking at individual wealth and client portfolios. But how do you actually calculate the wealth of an entire nation? That's exactly what we are breaking down today. We're going to show you how to measure national income simply by looking at the payments made to everyone who helped produce it. Let's jump right in.
Okay, let's lay out a quick roadmap for this Explainer. First, what is the income method? Second, we'll build the core rewards equation. Third, understanding mixed income. Fourth, factoring in foreign earnings. And finally, the all-important strict exclusion rules. We're basically going to build this national income equation piece by piece, just like a recipe.
All right, section one. What is the income method and why is it a new way to measure?
So imagine trying to count every single piece of physical economic activity happening in a country right now. Every single haircut, every car manufactured, every cup of coffee poured. The sheer difficulty of measuring all that physical output accurately is just mind-boggling. Oh, absolutely. The traditional output method is kind of like trying to count physical products in a giant national warehouse. It's incredibly prone to errors, especially double counting. But the income method, it takes a totally different, highly efficient approach. Instead of physically counting goods like shirts or bags of wheat, we just follow the money. We simply add up all the earnings, wages, and profits generated by individuals and businesses across the whole country.
Right, which brings us to the technical definition from our source material. The income method is also formally known as the factor cost method. Basically, this method estimates national income from the distribution side of factor payments. The absolutely crucial point here is this. Every single piece of value created in an economy ultimately becomes someone's income. By adding up all those individual incomes, boom, we arrive at the total national income.
Let's move to section 2, the core rewards equation. These are the building blocks. Now that we know we are adding up incomes, we need to know exactly what kind of incomes we're looking for. We're laying down the foundational ingredients of our national income recipe.
Exactly. First up, if you provide land to the economy, say you're leasing a plot to a manufacturing firm, your direct reward is rent.
Spot on. And if you provide labor, which, is most of us going to work every day using our skills and time, your direct reward is wages or salaries.
Then we have capital. If you deploy capital, like machinery or business loans, the reward generated from that is interest. And finally, enterprise. If you are an entrepreneur taking on the massive risk to bring land, labor, and capital together to start a business, your reward is profit. So rent, wages, interest, and profit, those are our primary foundational ingredients.
That brings us right to section 3, understanding mixed income, or the self-employed variable. Well, things aren't always quite that neatly categorized in the real world, are they? We need to introduce a little complication to that clean corporate equation we just built. Here is the highly relatable question we constantly ask. But what if you work for yourself? We see this all the time as advisors. Not everyone is just a pure employee or a pure landlord. For sure. And that's exactly why the concept of mixed income is so vital. It's the blended earnings of self-employed people where rent, wages, and profit are practically inseparable. Think about a local shop owner or a freelance artist working out of their garage. Or consider a farmer. If a farmer works on their own land, uses their own tractor, and takes all the risk, the money they make at the end of the harvest is a complete mix. It's rent for their land, wages for their physical labor, interest on their capital equipment, and profit for their enterprise. Because it's basically impossible to separate those streams out accurately, macroeconomic accountants just group it all into one big bucket and call it mixed income. Makes sense. Let's shift gears to section 4, factoring in foreign earnings, because money absolutely crosses borders.
As we all know, modern economies definitely do not operate in a bubble.
Right. We have to account for the flow of money in and out of the country. First, we have net exports, which is simply the value of our exports minus our imports, often written in economics as X minus M. And second, we have net receipts, which just means the receipts from abroad minus the payments made abroad, or R minus P. These foreign components are essential ingredients if we want to get the true, complete national picture.
And here is that complete picture. National income, or NI, equals rent plus wages plus interest plus profit plus mixed income, plus our foreign components, X minus M and R minus P. We've officially put all the ingredients together into the final recipe.
It really is incredibly satisfying to arrive at the final formula. But As advisors, we always have to warn our clients about the fine print. Just because money lands in your account doesn't mean it actually counts toward national income.
Which is the perfect transition to our final section, Part 5, the strict exclusion rules. What doesn't count? So, this is a crucial financial warning. If we want an accurate measurement of what an economy actually produced, we have to make absolutely sure we don't count the wrong things.
Exactly. We know our included list pretty well by now: wages, rent, interest, profit, and mixed income. But there is a strict list of exclusions. We must strictly exclude transfer payments, things like old age pensions, scholarships, and unemployment doles. Even financial gifts and charitable donations are out.
And we really want to heavily emphasize the why here, so you build deep intuition instead of just memorizing a list. Why exclude them? Because no new output was created to earn them. It is merely a transfer of existing income. Think about it. If the government taxes my wages, which were already counted in national income, and then hands that money to someone else as a pension, the pension isn't a new product or service. Counting it again would literally be double counting. We only ever want to measure new, real, current production. Right, let's quickly run through the other logical exclusions, which is something we constantly remind clients about when discussing economic value. First up, unpaid services. If a stay-at-home parent manages a household or a teacher tutors their own child after school, no official money changes hands in the market, so it's entirely excluded from national income. Second, the sale of secondhand goods, like used cars or older houses. The value of that house was already counted the year it was initially built. Selling it today is just a transfer of ownership, not current production. Third, the sale of shares and bonds. Buying stocks is just a paper financial trade. You're swapping cash for a certificate. It doesn't mean a new physical factory was built that day. And finally, illegal income from smuggling or gambling is entirely excluded because it operates completely outside the formal, measurable economy. It really makes you look at money differently, doesn't it? Which brings us to our final thought and a question we want to leave you with today. Look at your own bank statement. How much of your personal income actually reflects new value created for the economy, and how much is just a transfer or a paper trade?
It's a provocative thought to end on, for sure. Taking these massive macroeconomic concepts and applying them right down to your own household finances changes your entire perspective on wealth. Thank you so much for joining us for this explainer on the income method. Keep analyzing, keep learning, and we'll catch you next time.